Most investors are glued to the Fed's every move, thinking that's where the next big crypto crash will come from. They're watching inflation data, they're watching interest rates, and they might be looking in the completely wrong direction. The real danger isn't just coming from Washington, it's a systemic risk brewing right inside the crypto market itself. A high stakes conflict of visions between a Wall Street titan, JP Morgan, and a Bitcoin evangelist, MicroStrategy, is creating the perfect storm for a massive leverage fueled collapse. This isn't a story about charts and simple price predictions. It's about power, control, and the future of money. And in this video, I'm going to show you exactly how this battle is unfolding, the financial weapons being deployed, and how it all connects to a fragile house of cards built on leverage that could come tumbling down far sooner than anyone thinks. This is the story the mainstream isn't telling you. To understand the crash that's coming, you first need to understand the two giants at the center of this storm. On one side, you have the ultimate symbol of traditional finance, JP Morgan Chase, led by its famously skeptical CEO, Jamie Dimon. On the other, you have MicroStrategy, a software company turned Bitcoin zealot led by the unapologetic maxi, Michael Saylor. This isn't just a friendly competition, it's a fundamental clash between two opposing worldviews. First, let's look at the empire, JP Morgan. For years, Jamie Dimon has been one of Bitcoin's most powerful and vocal critics. He's called it a hyped up fraud and worthless. He has a long history of these remarks, arguing it has no intrinsic value and is primarily a tool for illicit activities. In a September 2025 interview, he warned that if inflation remains stuck at 3%, the Fed won't be able to easily cut rates, which could hurt speculative assets like Bitcoin. But here's where it gets interesting. Ever feel like the market is rigged? You're not entirely wrong. While Diamond publicly bashes Bitcoin, his bank is quietly building the infrastructure to control it. Since the launch of Bitcoin ETFs in 2024, JP Morgan has expanded access for its wealth management clients, allowing them to get exposure to Bitcoin through these regulated products. They don't let you buy Bitcoin directly or hold it for you. They want to keep it at arm's length, but they'll happily facilitate your purchase of a Wall Street approved product. Then they took it a step further. In June 2025, reports confirmed that JP Morgan would start accepting Bitcoin ETFs, like BlackRock's iShares Bitcoin Trust, as collateral for loans. Think about what this means. The bank, whose leader decries Bitcoin as worthless, is now willing to lend you real dollars against it. They will even factor crypto ETF holdings into your net worth, putting it on a similar level as traditional assets when you apply for financing. Even as recently as late 2025, while reiterating his personal skepticism, Diamond has admitted that blockchain and smart contracts are real and that the bank is ready to use the technology to make things better, faster, cheaper for clients. This isn't hypocrisy, it's a strategy. It's the classic playbook of the empire: contain, control, and co opt. If you can't beat the rebels, you sell them regulated weapons and build the financial system that profits from their activity. You keep the core asset at a distance while controlling the gateways. Now let's talk about the rebellion led by Michael Saylor and MicroStrategy. Saylor isn't just buying Bitcoin, he's attempting to build a parallel financial system on top of it. He envisions a future built on a corporate Bitcoin standard, where companies don't just hold Bitcoin as a reserve asset, but use it as the foundation for their entire capital strategy. MicroStrategy's game plan is aggressive and audacious. The company has taken on billions in corporate debt, primarily through convertible notes, for one main purpose: to buy more Bitcoin. This is a direct challenge to the traditional banking model. Instead of relying on a bank for deposits and loans, MicroStrategy is effectively using the capital markets to become a Bitcoin acquisition vehicle, a move Saylor calls a digital transformation of the capital markets. While it's not literally becoming a bank from a regulatory standpoint, its strategy is a clear proof of concept for a new kind of financial institution built on the Bitcoin standard. They are creating an alternative, and that makes them a direct threat to the dominance of institutions like JP Morgan, who rely on their position as the central hub for finance. You have one side trying to tame Bitcoin and fit it into the old world, and the other trying to use Bitcoin to build a new one. This fundamental conflict has moved beyond words and is now being fought in the sophisticated arenas of financial regulation and market structure. This brings us to the hidden war itself. This isn't a war fought with armies, but with financial instruments, regulatory filings, and market mechanics. It's a subtle, complex conflict, but its consequences could be devastating. There are two primary weapons in this fight, and both are aimed squarely at MicroStrategy's foundation. The first, and most immediate, is what could be called the index reclassification attack. Major stock indexes, like those managed by MSCI, are the plumbing of the global financial system. Trillions of dollars in passive investment funds are programmed to automatically buy and sell whatever stocks are in these indexes. Being included is critical for a company's stock liquidity. Being excluded can be catastrophic. Right now, MSCI is in the middle of a consultation on whether to change its rules for companies that hold a large amount of digital assets. The proposal on the table could lead to the reclassification or exclusion of any company that holds a significant portion of its assets, say over 50%, in something like Bitcoin. While the rule is written broadly, make no mistake, MicroStrategy is the poster child and primary target for this change. Why? MSCI's argument is that a company holding this much of a single asset starts to behave more like an investment fund, which has different rules. But critics, including MicroStrategy itself, have pushed back hard, calling the proposal discriminatory, arbitrary, and unworkable. They argue that penalizing a company for holding Bitcoin is like penalizing an oil company for holding oil or a real estate company for holding property. They see it as a targeted attack on a specific asset class. The danger here is enormous. Analysts at JPMorgan themselves have estimated that if MicroStrategy is excluded from MSCI indexes, it could trigger forced selling from passive funds to the tune of $2.8 billion. If other index providers follow suit, some estimates suggest that number could balloon even higher. This forced selling would have nothing to do with the value of Bitcoin or the performance of MicroStrategy's software business. It would be a purely mechanical event, a structural shock caused by a rule change. The decision from MSCI is expected in early 2026, making this a very near-term threat. This is weapon number one, using the very rules of the old financial system to kneecap its most prominent digital challenger. The second weapon is more hypothetical, but just as potent, the prime brokerage squeeze. JP Morgan isn't just a commercial bank, it's a prime broker. This means they provide essential services to hedge funds and other large institutional players, including lending them money to make leveraged bets. One of the key levers a prime broker has is setting margin requirements, how much collateral a client has to post to back their trades. Now, imagine a scenario. If MSCI forces a massive sell-off in MicroStrategy's stock, MSTR, the price will plummet. A prime broker like JP Morgan could, in theory, see this as an opportunity to turn the screws. They could suddenly increase the margin requirements for holding MSTR stock or for using it as collateral. This would force leveraged investors to sell their MSTR positions immediately to meet the new stricter requirements. This action would pour fuel on the fire, accelerating the stock's crash and putting immense pressure on MicroStrategy itself. It would create a vicious feedback loop where falling prices lead to higher margin calls, which lead to more forced selling, and so on. While there is no public evidence that JP Morgan is actively planning this, it is a tool in their arsenal. In a high-stakes conflict, you have to assume that all available weapons will be considered. It represents a critical structural vulnerability for any company that becomes a target of the financial establishment. This conflict between JP Morgan and MicroStrategy isn't happening in a vacuum. It's happening on top of a crypto market that is, once again, a tinderbox of extreme leverage and underlying stress. These internal market dynamics are what could turn a targeted attack on one company into a full-blown systemic contagion. Let's start with the most explosive element, leverage. The crypto market runs on it. Futures, perpetual swaps, and options create a massive web of borrowed money betting on price movements. According to a November 2025 report from Galaxy Research, total crypto collateralized lending reached a new all-time high of nearly $74 billion in the third quarter of 2025. At the same time, derivatives markets have seen huge activity, with futures open interest swelling across major venues. While some recent data from Coinbase Institutional suggests that a de-risking phase in November 2025 brought system-wide leverage down to a healthier level, flushing out some speculative excess, the system is still incredibly sensitive. High leverage acts as an amplifier. A small drop in price can trigger a cascade of liquidations. When the price of Bitcoin falls, leveraged long positions get automatically closed out, which means the exchange forcibly sells the underlying collateral, more Bitcoin, onto the market. This forced selling pushes the price down further, which in turn triggers the next wave of liquidations at a slightly lower price point. This is the liquidation cascade, a domino effect that can turn a small dip into a huge crash in a matter of hours. We've seen it happen time and time again, and the conditions are ripe for it to happen again. A sudden, sharp drop in Bitcoin's price, like one that could be sparked by forced selling of MSTR, would be the match that lights this fuse. But it's not just traders who are on edge. The very producers of Bitcoin, the miners, are also under immense financial stress. This creates another layer of fragility. The Bitcoin halving in April 2024 fundamentally altered the economics of mining. It cut the block reward in half, effectively doubling the cost of production overnight for many miners. While the network's hash rate has remained robust, hitting new highs in late 2025, profitability for many has been crushed. According to various analyses from 2025, the average cost to mine one Bitcoin has risen dramatically, with some estimates putting it between $70,000 and over $84,000, depending on the miner's efficiency and location. With the Bitcoin price hovering around the $90,000 range in late 2025, margins have become razor thin or even negative for less efficient operators. Profitability for some has hit historic lows. This puts miners in a precarious position. They have massive operational costs, electricity, hardware, maintenance that need to be paid in fiat. When their profit margins disappear, they have only two choices: shut down their machines or sell the Bitcoin they have in reserve. This is what's known as miner capitulation. If the price of Bitcoin takes a sudden hit, many of these miners who are just barely breaking even will be pushed over the edge. They will be forced to sell their holdings to cover costs, adding massive selling pressure to an already falling market. This can create a miner death spiral, where falling prices force miners to sell, which drives prices down further, forcing even more miners to sell. We can get a sense of miner sentiment by looking at the Puel multiple, an indicator that compares the daily value of issued Bitcoins to its 365-day moving average. Historically, when this multiple drops into the green zone, typically below 0.5, it signals that miner revenue is critically low, often corresponding with market bottoms and high stress. As of late 2025, the Puel multiple is hovering in a neutral zone, well out of deep distress, but also far from overheated highs, suggesting miners are profitable but still vulnerable to a sharp price shock. So you have a market saturated with leverage, ready to cascade downwards, and a population of miners under severe financial pressure, ready to capitulate. This is the tinderbox. All it needs is a match. Look, I know this is a lot to take in. These are complex, hidden forces that don't show up in your standard market analysis, but understanding them is the key to navigating what's coming. If you're getting value from this deep dive and you want to stay ahead of these hidden market dynamics, take a second to hit that subscribe button and turn on notifications. It's free and it ensures you won't miss the next piece of the puzzle. All right, let's connect the dots. So, how does this all tie together? How does a corporate battle on Wall Street translate into your crypto portfolio getting wiped out? Here is the hypothetical scenario that a lot of smart money is quietly watching, a potential domino effect that links everything we've just discussed. Domino 1, the index attack succeeds. The fuse is lit in early 2026. MSCI announces its decision. Due to pressure or by-the-book interpretation, it reclassifies companies with heavy digital asset treasuries. MicroStrategy, being the most visible company of its kind, is kicked out of major global stock indexes. Domino 2, the purge of passive funds. The machines take over. The billions of dollars in passive index funds that are required to hold MSTR stock are now forced to sell. It's not a choice, it's an automated mechanical purge. This creates a supply glut and the price of MSTR stock begins to plummet, completely disconnected from Bitcoin's price or the company's underlying business. Domino 3, the Bitcoin contagion. Because MicroStrategy is the largest corporate holder of Bitcoin, its fate is deeply intertwined with the asset itself. A collapse in MSTR's stock price creates massive fear, uncertainty, and doubt in the crypto market. The narrative shifts. If the biggest Bitcoin bull is getting taken down, what does that mean for Bitcoin? This psychological shock triggers the initial sell-off in Bitcoin itself. It doesn't have to be rational. In markets, perception is reality. Domino 4, the leverage cascade. This initial price drop, perhaps only 5 or 10%, is all it takes to trigger the first wave of liquidations in the hyper-leveraged derivatives market. The dominoes start to fall faster. Forced selling from liquidated longs pushes the price down further, triggering the next wave and the next. The market enters a full-blown cascade, a violent deleveraging event that feeds on itself. Domino 5, the miner death spiral. As the Bitcoin price crashes through key support levels, maybe $85,000, then $80,000, it falls below the average production cost for a significant portion of the mining network. Miners who are already on the brink are now deeply unprofitable. They have no choice. They begin to capitulate, selling their treasured Bitcoin reserves to pay their power bills. This injects hundreds, then thousands of Bitcoins of fresh sell pressure into a market already in free fall, accelerating the crash and ensuring a deep, painful bottom. This is the feedback loop from hell. A regulatory attack leads to forced selling in one stock, which creates fear that infects the crypto market, which triggers a leverage cascade, which in turn causes a minor capitulation. It's a perfect storm where every component amplifies the others, leading to a collapse that seems to come out of nowhere, but was in fact structurally inevitable. So, if this perfect storm is brewing, what's the solution? Is it to panic sell everything? No. The solution isn't an action, but a state of mind, awareness. The solution is knowledge. By understanding this hidden game, this conflict happening behind the curtains, you can protect yourself and even position yourself to act rationally when others are acting on pure emotion. Most retail investors are playing checkers, watching the Fed and the daily price chart. The institutional players are playing three-dimensional chess using market structure and regulation as weapons. This video is about giving you a view of their board. So, what can you do with this knowledge? This is not financial advice, but here are some strategic ways to think about it. First, start watching MicroStrategy, MSTR, stock, not just as a Bitcoin proxy, but as a leading indicator of this specific risk. Pay close attention to news surrounding the MSCI decision in early 2026. If MSTR begins to show significant weakness that is disconnected from Bitcoin's price, that could be your early warning sign that this domino chain is starting to wobble. Second, monitor leverage metrics in the crypto market. Keep an eye on open interest, funding rates, and the estimated leverage ratio. If you see leverage building back up to extreme levels, know that the tinderbox is getting drier and the potential for a violent cascade is increasing. Third, understand your own portfolio's risk. Are you over-leveraged? Are you holding assets you don't fully understand? A crash fueled by forced liquidations and structural attacks is indiscriminate. It will punish those who are overexposed. Knowing the potential for this kind of violent downside event should force you to be brutally honest about your own risk tolerance. Ultimately, by understanding the game, you stop being a pawn in it. You can see the bigger picture beyond the daily noise and recognize the signs of structural risk before they become front-page news. You can distinguish between a normal market correction and the beginning of a systemic leverage-driven collapse. So while everyone else is watching the Fed, you now know where a real danger may lie. It's not just in macroeconomics, but in market mechanics. The battle between the old guard of Wall Street, represented by JPMorgan, and the new wave of financial disruption, led by MicroStrategy, has created a series of tripwires across the market. A regulatory move against a single company could trigger a cascade of forced selling, which could ignite the vast tinderbox of leverage in the derivatives market, leading to a final crushing wave of selling from financially stressed Bitcoin miners. This isn't a certainty, but it is a significant and overlooked risk. It's a structural vulnerability that has been methodically put in place. The next major crash may not be a gentle slide. It could be a sudden, violent, and structurally driven collapse. But now, you know what to watch for. You know the players, you know the weapons, and you know the potential sequence of events. And in a market defined by information asymmetry, that knowledge is your single greatest defense. What do you think is the biggest threat to Bitcoin right now? Is it this internal conflict, or is it still the macro environment? Let me know your thoughts in the comments below. Stay safe and stay informed.